President Donald Trump is reported to be considering more tariff exemptions, this time for automakers on imports from China that was imposed to counter fentanyl production, as well as levies on steel and aluminium. And at the International Monetary Fund spring meetings earlier in the week, IMF Director of Fiscal Affairs Vitor Gaspar warned of rising global public debt now at historic levels and intensifying fiscal pressures. Global public debt, according to him, is surging above the pandemic peak, contributing to narrower fiscal space and also making policy trade-offs more complicated.
The Spring Fiscal Monitor documents that global public debt is high and rising, approaching 100% of GDP by the end of the decade and surging above the pandemic peak. High debt, low growth, rising interest costs, spending pressures, and elevated policy uncertainty contribute to narrower fiscal space, making policy trade-offs starker and policy choices more painful. The Fiscal Monitor shows that public finance positions and prospects are very different across countries. Countries will need to first and foremost keep their own house in order. This involves three key priorities. First, fiscal policy should be part of overall stability-oriented macroeconomic policies. Second, fiscal policy should, in most countries, aim at reducing public debt and building buffers to create space to respond to spending pressures and economic shocks. Lastly, fiscal policy should, together with other structural policies, aim at improving potential growth, thereby easing policy trade-offs. If a crisis occurs, fiscal policy has an important role to play. First, it should support the central bank in its efforts to preserve financial stability and orderly market conditions. Such complementarity was crucial in recent episodes, as in the Great Financial Crisis and the pandemic. Second, fiscal policy should be counter-cyclical. It is crucial that the public sector leans against the wind of private sector deleveraging. Otherwise, the crisis will be deeper and longer, but this requires fiscal space. Third, in extreme cases, public finance may be at the center of the crisis, and timely and orderly debt restructuring may be required. In these times of high uncertainty, fiscal policy must be an anchor for confidence and stability that helps delivering growth and prosperity for all. A crisis is by no means a foregone conclusion. There is still time to build a more balanced, resilient global economy. Ministers of Finance must build trust, tax fairly, spend wisely, and take the long view.
Hello and welcome to Global Business Insights, where we look closer at some of the headlines moving markets and try to join the dots to equip viewers to succeed in the marketplace. US stock markets surged earlier yesterday after reports that the administration was considering slashing tariffs on Chinese imports. Gains later slipped, though the market is still rallying broadly, and we've seen some improvement over the last few days, looking at the bearish nature of markets of recent. Apple was fined 500 million euros, that's $570 million yesterday, and Meta 200 million euros after a year-long investigation by the European Commission on if the companies comply with the Digital Markets Act, DMA, that checks anti-competitive domination by the biggest companies. Trump has always seen these fines as indirect trade barriers penalizing US companies. UK Chancellor Rishi Sunak says the UK could lower tariffs on US car imports as she tries to broker a trade deal with the US, adding that she wants to see tariff and non-tariff barriers reduced between the UK and the US. Oil prices were down more than 2% yesterday as OPEC Plus accelerates production increases in June amid continued tensions between key members. 8 OPEC Plus members, including Saudi Arabia and Russia, plan to boost headline oil output in May by 411,000 barrels a day, up from a previously targeted increase of 122,000. When the members meet on May 5 to set output targets for June, we could also see an increase in production by a similar amount. Gold sank more than 2.5% yesterday as risk appetite improved due to speculation of de-escalation of US-China tensions and the statement that there are no plans to fire Federal Reserve Chair Jerome Powell. Texas Instruments in Q1 2025 reported earnings per share of $1.28 compared to Wall Street's estimate of $1.07. Revenue came in at $4.07 billion, which was better than analysts' expectation of $3.91 billion. Texas Instruments also gave a solid outlook with a revenue forecast range for the current quarter of $4.17 billion to $4.53 billion, above the estimate of $4.1 billion. United Bank for Africa (UBA) announced its Q1 2025 net profits after tax as rising 33.15% to 189.84 billion naira compared to 142.58 billion naira recorded in the same period last year. Interest income remained a significant driver of growth, hitting 599.83 billion naira, also a 36.09% increase year on year. High interest rates in Nigeria has always been a boost for the major lenders in the country. At a closed-door meeting earlier in the week on the sidelines of the ongoing IMF World Bank meetings in Washington, D.C., the managing director of the IMF, Kristalina Georgieva, the governor, Central Bank of Nigeria, Yemi Cardoso, and Nigeria's Minister of Finance and coordinating Minister of the Economy, Mr. Wale Edun, have pledged to continue to work together to scale up social spending, improve security, and promote inclusive growth in Nigeria. The MD of the IMF also reiterated her support for Nigeria's economic reforms. Rwanda said yesterday that it was in talks with the US over a potential minerals deal. The similar ongoing talks between Washington and Rwanda's neighbor, Democratic Republic of Congo, where the US is currently engaged in talks over a potential minerals for security deal. Vedanta Resources is considering a U.S. public listing for its Zambian unit, Konkola Copper Mines, as one of its options to raise about $1 billion for mine development. The miner, owned by Indian billionaire Anil Agarwal, is reported to have hired Barclays and Citigroup to advise on the plans for an initial public offering. Our deep dive is looking at some of the April economic data just out this week, with the first flash PMI indicators showing some sluggishness in Europe, the UK, and also in the US. The US data shows activity and expansion, but the data shows a slower expansion, while in Europe and the UK we are still seeing contraction with little evidence of recovery. The more dominant services sector is doing better in most Western economies, but demand is also cooling. In the US, manufacturing is attempting a recovery. Let's look at the data in more detail. US preliminary reading of S&P Global's composite PMI showed US business activity expanded at a slower pace in April, with the index easing to 51.2 from March's 53.5. Manufacturing PMI inched up to 50.7 from 50.2, while services PMI fell to 51.4 from 54.4, a sign that demand in the dominant services sector, like I said, may be losing steam. In the UK, the S&P Global UK Manufacturing Purchasing Managers Index eased to 44 in April from 44.9 in March, also matching expectations or consensus of 44. Meanwhile, UK Services Business Activity Index contracted. That was at 48.9 in April versus March's 52.5, and coming in below 51.3 that was expected. In the Eurozone, manufacturing sector remained in contraction as the PMI improved to 48.7. That's manufacturing in April from 48.6, just a marginal improvement, beating expectations of 47.5. Services in the Eurozone saw PMI falling to 49.7. That's April from 51 in March, and below the estimated 50.5 print. Also a 5-month low. The Eurozone PMI composite arrived at 50.1 in April, following March's 50.9 and less than market consensus of 50.3. That's the composite PMI. We are yet to see the impact of tariffs, but we have seen an early ramp up in activity to stock up ahead of expected tariff announcements amid a pause which is meant to allow negotiations, even though many of these tariffs seem to be settling somewhat in terms of where they are going to eventually land. According to the IMF, higher tariffs imply a markdown in growth but not a recession, and it's still too early to appreciate the full impact, as much is still yet, like I said, to settle, as tariff negotiations, I would say, still in very early stages. Later today on data, we get the US weekly initial jobless claims, Chicago Fed National Activity Index, durable goods orders data, and the existing home sales data in the US to shed more clues on the economic climate. South Africa's Finance Ministry has announced the decision to suspend the planned value-added tax increase, which was set to take effect on the 1st of May. The proposal, involving a 1% hike spread over 2 years, faced significant opposition from political parties, leading to internal tensions within the coalition government. In the latest financial report, IBM outperformed expectations in Q1 2025, with earnings per share reaching $1.60, surpassing the estimated $1.42 per share. Despite a slight decrease from the previous year's $1.68 per share, the quarterly revenue exceeded projections, totaling $14.54 billion and reflecting a 1% year-on-year increase. Chief Executive Officer Arvind Krishna affirmed the company's steady 2025 revenue and cash flow guidance amidst the evolving macroeconomic landscape. SK Hynix Q1 earnings release underscored the growing influence of artificial intelligence in the memory market and the company's robust position for seeing sustained tech investments in AI. The first quarter revenue surged by about 42% to 17.64 trillion won. That's $12.36 billion, surpassing the anticipated 17.26 trillion won. Operating profit also notably increased by 158% year-on-year. However, a quarter-on-quarter comparison revealed a decline of 11% in revenue and an 8% drop in operating profit from the previous quarter's peak. Business sentiment in Germany improved slightly in April, with the IFO Business Climate Index rising to 86.9 from 86.7 in March, also above expectation. Asia Pacific markets traded mixed following gains on Wall Street and investor optimism to see a breakthrough in resolving US-China trade tensions. In a concerning economic development, South Korea recorded a 0.1% year-on-year GDP contraction in the first quarter, marking its first decline since Q4 of 2020. This downturn missed the expected 0.1% growth and contrasted with the 1.2% expansion in the final quarter of 2024, with the construction sector notably contributing to the negative trend. Well, that's all on this episode of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.